Why now and where next for emerging market debt? We believe there's much for investors to be positive about in emerging markets. The positive economic fundamentals and excess yield opportunities presented by emerging market debt make this, in our opinion, an appealing asset class for investors to be increasing their allocations to. Now seems to us a particularly good time to consider increasing allocations to emerging market bonds. That said, investors need to handle this asset class with care. Now let me go through some of the positives we see in this asset class. Many of the risk factors that had investor concern in recent years have receded in our opinion. Firstly, let's consider international trade, which came into focus after Donald Trump's victory. Fears of a drop in international trade flows spiked heavily. What has materialized, however, is that many of Trump's most feared policies, especially risk of a major clash with China, have either been voted down or abandoned to the relief of many investors. Secondly, and crucially, emerging markets themselves are now on a much stronger footing than in previous years. For instance, economic growth has picked up, with many economies now in a much stronger position. A further positive is that inflation in most of these economies remains low or is coming down, allowing central banks to keep interest rates low or even to reduce them. The knock-on effect of this has been that real interest rates in a lot of these economies is now at multi-year high levels. Last but not the least, emerging market currencies appear to be heavily undervalued. We believe this strengthens the case for emerging market investment strategies that are denominated in local currencies. Now let me go into some of the risk factors that still exist for emerging market debt. These include an unexpected aggressive increase in US interest rates or a sudden return of trade protectionism to the political agenda. In addition, of course, are the political risks within emerging markets themselves. As investors become increasingly aware that emerging markets are in fact a collection of very diverse economies, it follows that the impact of various risk scenarios will vary significantly from country to country. For us, this means that the approach to investing in the asset class has never been more critical. In addition, we should not forget the fractured liquidity environment, which came back into focus in mid-May post the Brazil scandal. Therefore, the combination of these two factors imply that traditional investment approaches, which rely on market capitalization, pose significant risks for investors in our view. Instead, constructing a portfolio according to meaningful criteria, such as the fundamental strength of the country issuing the bond, can help investors to focus on quality issuers while reducing the reliance on frequent trading, which in our view mitigates the challenges coming from the damaged liquidity environment. Overall, to sum up, we believe that emerging debt in local currency currently presents a long-term value opportunity for investors, but we must think carefully about implementation.